Want to unlock the path to financial freedom and learn how to grow your money? Well, in this video, I will reveal Robert Kiyosaki's 6 investment rules that will help you master the basics of investing and pave your way to wealth. Investing can seem intimidating, but here I'm to simplify it for you. Whether you're a complete beginner or already have some experience, these 6 rules I'm about to share will give you knowledge and confidence to grow your money like never before. By following these simple rules that Robert Kiyosaki swears by, you will be well on your way to growing your money and securing a brighter financial future. So, let's jump right in and learn how investing can be made simple. Investing success isn't solely about crunching numbers and reading market trends, it's equally about cultivating the right behaviors and attitudes. One common pitfall that many people encounter when experiencing a sudden influx of wealth is failing to adjust their behaviors accordingly. This often leads to hasty spending, extravagant lifestyle choices, and a lack of careful planning for the future. Such impulsive behavior can result in squandered opportunities and financial instability in the long run. To counter this, it's imperative to recognize the need for behavior change, a shift from the consumer mindset to an investor mindset. This entails discipline, patience, and a willingness to learn, all of which lay the foundation for making informed, thoughtful investment decisions. By acknowledging the importance of behavior change, we can avoid the pitfalls that ensnare many and set ourselves on a path of sustained investing success. When it comes to investment strategies, Robert Kiyosaki's insights stand out from the crowd. Rather than adhering to conventional wisdom, Kiyosaki advocates for a focus on cash-flowing assets, investments that generate consistent income over time. This approach shifts the emphasis from speculative gains to tangible, reliable returns. To steer clear of the mistakes that often plague investors, Kiyosaki introduces 6 key principles he learned from his rich dad. These principles encompasses concepts such as investing in education, embracing calculated risks, leveraging other people's expertise, and maintaining a strong financial foundation. Basic investing rule number 1: understanding income types. In the world of investing, understanding the different types of income is a cornerstone for success. And Robert Kiyosaki's rich dad laid down these fundamental principles. There are 3 primary income types: earned income, portfolio income, and passive income. Each possesses unique attributes that significantly shape one's journey to financial prosperity. Earned income. This form of income arises from traditional employment where individuals change their time and expertise for compensation. While it's the most common income source, it's also the most taxed and limited by the number of hours one can work. Portfolio income. This category encompasses income generated from investments in stocks, bonds, and mutual funds. Portfolio income is linked to the performance of financial instruments, and while it can provide higher returns than earned income, it's subject to market fluctuations. Investors must navigate the risks associated with market volatility, and though it's more passive than earned income, its potential for wealth growth might be moderate. Passive income. The ultimate goal for investors seeking financial freedom, passive income stems from ventures like real estate investments, royalties, and dividends. Unlike the previous 2 income types, passive income shines as a powerhouse for wealth accumulation. It enjoys favorable tax treatment, isn't tied to hourly commitments, and has the potential for exponential growth. As Rich Dad wisely proclaimed, if you want to be rich, work for passive income. Basic investing rule number 2: converting ordinary income. Kiyosaki's approach to financial independence centers around the concept of transforming ordinary, earned income into passive streams of revenue. The idea is to break free from the cycle of trading time for money and create a self-sustaining system that generates income when they're not actively working. This can be achieved by strategically investing in cash-flowing assets such as real estate, stocks, bonds, or businesses. Kiyosaki's rich dad uses a simple yet impactful diagram to illustrate this transformative journey. At the starting point is earned income, often derived from employment. The diagram showcases how ordinary earned income can be directed towards investments that generate passive income, such as real estate, royalties, or dividends. As you consistently invest in cash-flowing assets, your dependence on active work decreases over time, and your wealth accumulation becomes more sustainable. When it comes to conventional financial advice, the emphasis is often placed on saving and contributing to retirement accounts like 401ks. While saving is important, it can pale in comparison to the potential of investing in cash flow assets. Rather than letting your money languish in low-yield savings accounts or traditional retirement plans, Kiyosaki advocates for redirecting your funds into assets that generate ongoing streams of passive income. By doing so, you not only maximize the growth potential of your wealth, but also accelerate your journey towards achieving financial freedom and mastering the art of investing. Basic investing rule number 3. The investor as an asset or liability. Rich Dad's wisdom on the importance of financial education echoes loudly within the principle. He emphasizes that becoming a proficient investor isn't just about memorizing formulas or following trends, it's about fostering a deep understanding of financial concepts and continuously expanding one's knowledge base. Learning from mistakes is a central tenet of this approach, highlighting the setbacks are opportunities for growth, allowing investors to refine their strategies and avoid repeating errors. This principle also introduces the idea of starting small and progressively scaling up investments. Think of investing as a skill to be honed. Just as you wouldn't expect to master a new instrument overnight, becoming a proficient investor takes practice and patience. By beginning with smaller investments, you gain hands-on experience, build your decision-making abilities, and develop the confidence needed to navigate the complexities of investing. Basic investing rule number 4. Being prepared. Being prepared is a fundamental pillar of successful investing. Robert Kiyosaki emphasizes that the best opportunities often present themselves unexpectedly. By being prepared both financially and mentally, investors can capitalize on these opportunities without hesitation. For example, imagine a scenario where the stock market experiences a sudden dip due to the unforeseen circumstances. Those who are prepared with the contingency fund and a deep understanding of market funds, and the trends as well, might see this as a chance to buy valuable stocks at a discount. Similarly, real estate markets can fluctuate, offering savvy investors a chance to purchase properties at favorable prices during downturns. In Kiyosaki's investing philosophy, education reigns supreme. Constant learning is akin to having a compass in a world of financial landscapes. Staying attuned to market shifts, understanding industry trends, and mastering diverse investment strategies is key. Imagine a scenario where you're considering investing in a new technology trend. With thorough education, you can discern hype from true potential, and thus making informed decisions. Basic investing rule number 5. Good deals attract money. When you stumble upon an exceptional investment opportunity, be it in real estate, business ventures, or other avenues, the attractiveness of the deal itself becomes your greatest asset. Savvy investors recognize that putting their money into a promising venture is far more appealing and lucrative than letting it slide. Robert Kiyosaki's Rich Dad shared that when you have a genuine, valuable investment proposal, securing funding becomes a lesser challenge as investors are more inclined to partner with you. This leads us to the concept of other people's money, or OPM. By effectively leveraging OPM, you're tapping into external resources to finance your investment endeavors. This could involve securing loans, finding partners, or engaging in creative financial arrangements. Successful investors understand that you don't necessarily need to use your own money to fund a venture. The key is to have a solid plan and a compelling investment opportunity that speaks for itself. Being prepared and well-informed isn't just a suggestion, it's your ticket to attracting money for phenomenal deals. When you've sharpened your financial intelligence through education and learning from experiences, you radiate confidence. Potential investors can sense your expertise and trust your judgment, making them more likely to partner with you. Imagine discussing your investment strategies with backers who are eager to join forces because they see a value in your approach. This confidence, coupled with a knack for spotting exceptional opportunities, positions you to effortlessly attract money for the basic investing rule number 6. Evaluating risk and reward. Consider this scenario. Imagine you have the opportunity to invest in a burger stand. At first glance, you might think it's a good investment due to its familiarity and apparent simplicity. However, applying the principle of evaluating risk and reward, you delve deeper. Suppose your nephew, who has spent 15 years working in a prominent burger chain and has extensive experience, is offering you the chance to invest $25,000 for a 5% stake in his new venture to create a worldwide burger chain. Here, the risk isn't just about the nature of the investment, but about the expertise and track record of the individual behind it. By assessing both the potential reward and the level of risk involved, you can make a more informed decision on whether the investment aligns with your goals and risk tolerance. To become a successful investor, it's crucial to continuously learn and refine your skills in. reevaluating risk and reward. As Robert Kiyosaki's rich dad wisely advised, the journey of investing is an ongoing process of education and application. By learning from both successes and mistakes, you develop a more refined sense of judgment when it comes to investment opportunities. If you enjoyed this video, guys, make sure to subscribe to the channel, like the video, and watch this one as well.